You think Bitcoin's going to go through a multi-year bear market where QT is ending December 1st, QE has to start, rate cuts, Japan blowing up, AI needs a federal backstop or else we go into a recession. AI is going to displace 50% of entry-level white-collar jobs. AI is going to send unemployment to 20%. The U.S. government relies on employment to finance its interest payments because people that are employed spend in the economy and pay taxes. Oh, and then Trump gets to place who he wants to be as Fed chair in May, right before midterms. Tell me again that Bitcoin's going to go through a 2 to 3 year bear market? Miss me with that shit. Not on this show.
Something's breaking, and it's not Bitcoin. As December 1st creeps closer, the financial tides are shifting fast. Quantitative tightening is ending. Liquidity, once choked off, is about to flood back in. Meanwhile, AI isn't just knocking on the door, it's kicking it down. We're staring at a tech-driven recession, one that doesn't wait for blue-collar layoffs. It starts with entry-level analysts, assistants, and coordinators. Half of them could be gone in months. And when that happens, consumer spending tanks, tax revenues shrink, and the whole fragile balance of the U.S. economy gets exposed. Jack Mallers sees the setup for what it is, not a bear market, but a powder keg. While some still argue Bitcoin has years of pain ahead, Mallers isn't having it. With unemployment set to spike and the government relying on an already weakened workforce to cover interest payments, the math doesn't work. You can't tax empty desks. And if liquidity is returning just as AI clears out the job market, the only hedge left standing might be the one asset no one can print. Oh, and let's not forget, Trump could name the next Fed chair in May, right before the midterms. You still think Bitcoin's going down? Let's watch more clips from Jack Mallers' OK latest market analysis. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
So Bitcoin found a low, for now, around $80,000. On the last show, I told you guys, it could fall to 85, it could fall to 80, it could fall lower. I don't know. This is not the top. What 126 was not the top. It's not the end of the cycle. And so we did find somewhat of a low for now around that $80,000 number. We have since bounced quite a bit. There's a lot that has happened. I want to walk you guys through the data because a lot of people seem to have found value in my liquidity vantage point, how I was viewing the cycle, how far we are off from highs. I've been in Bitcoin for 13 years. I've seen 30% drops from highs, and then we rally further. My favorite memory was in 2017. And so let's walk through it. First slide, supply distribution. So this from the rational root, more than 5% of all Bitcoin changed hands during this drawdown. Guys, let me repeat that for you. More than 5% of the entire Bitcoin supply changed hands. Look at that spike between 83K and 86K. This, guys, is what we want to see. This is forced selling. This is panic selling. This is capitulation. It's very difficult for Bitcoin to continue to go lower and lower and lower and lower when you've seen this level of capitulation and distribution, okay? Bitcoin is not slowly bleeding down. It's not struggling to find momentum. I fundamentally believe that we are, the overall market is trying to sort out what I would call liquidity dislocation. When the U.S. government runs a $200 billion trade surplus in September, which implies that we run a $2 trillion trade surplus annually. We know that's not true. We know that's gimmicky. That was very likely to try and fill the TGA, the Treasury General's account. Then for the government to shut down, again, that was very helpful in drying up liquidity and concentrating it in the Treasury General's account. And so I think that this is liquidity dislocation, extreme tightening in a really weird time that was fairly unexpected. This was an unexpected event. Next, let's look at Bitcoin's implied volatility. The implied volatility is extremely low, and this is relevant for a few reasons. For one, this kind of solidifies this idea that Bitcoin has not reached peak price discovery all-time highs. Our volatility, if you look at our volatility, this goes all the way back to 2022. You can see in early 2022 that extreme peak implied volatility was when we were setting all-time highs. Jerome Powell went on and hiked rates as fast as they've ever been hiked, crashed all markets, rendered banks insolvent, FTX imploded, so on and so forth. We've been at relatively low volatility since then, and even on this flush, even on this decline from all-time highs. And the reason I want to reference that and bring that up is usually you see extremely high volatility on declines, like when the market is puking, and we didn't. And so again, this to me looks like it was forced selling in extremely illiquid markets. The market did not expect this downturn, and there were no structured bids to go catch it. So this, again, just further solidifies my point that no one was actively bidding, no one expected a meltdown, and the market had just low liquidity. Next, Bitcoin unrealized profit and loss. So what are you looking at? The black is Bitcoin's price. Red, orange, yellow, green, blue. Those signal in color different feelings, market structures throughout price action. So what we're looking at in green is belief and denial. So effectively, cut to the chase. Can you guys see my cursor? Do you see this massive dip in sentiment right below the price? That is extremely profound. So what this is showing us is the percentage of unrealized profit versus loss across the entire Bitcoin supply. And we dropped substantially, which means that a lot of unrealized profit evaporated. So we're not in euphoria and greed. We're not in denial. We're not in the hope and fear. This is very much par for the course for a mid-cycle anxiety zone. 30, 35% off the highs. Guys, this is exactly what we saw in April. Do you guys see the break between green and yellow back here in April? That was Liberation Day, Liberation Week. Stock market down 20%, Bitcoin down 35% from highs, everyone screaming for a Great Depression. And then all of a sudden, liquidity came back and we rallied to 126,000 in Bitcoin. The stock market made new highs and everything was fine because they printed the money. They printed the money. And so again, this to me is not a red capitulation. I don't see the color orange of extreme fear. This very simply is anxiety. This very simply is illiquidity. Next, the IBIT ETF flows. Let's look at the outflows. So what are you looking at? The orange line is Bitcoin's price and the green is IBIT's flows. You can see they've gone negative. You've probably seen some headlines like, oh my goodness. IBIT made record outflows. Institutions don't love Bitcoin anymore. The outflows are on par with when? With Liberation Day, with earlier this year. Nothing to worry about. There have been structural inflows this entire time. We also talked about the carry trade. When the carry trade unwinds, you see outflows in the ETF. If anything, all of the tourists have exited the IBIT product. So what we'll talk about is short-term holders, speculative traders. They have been washed out and really they realize their positions as losses. But if you zoom out and you look at the IBIT product, it's fairly straightforward. When there is no liquidity, Bitcoin reacts the most. When there's liquidity, Bitcoin reacts the most. We went through this very weird liquidity dislocation with a government surplus in September and a government shutdown. The repo markets are extremely strained, which we'll talk about in a second. Japan is blowing up. Literally, Japan is acting like an emerging market, which we'll talk about in a second. And so Bitcoin, very simply, is the liquidity smoke alarm it was designed to be. The IBIT flows are nothing to be concerned about. We are just going back to Liberation Day outflows because there is no liquidity. It's all a good thing. Next, spent volume in profit. Okay, what are we looking at here? Volume of Bitcoin sold at a profit, segmented by how long the coins were held. So red is extreme short-term holders, blue is much longer-term holders, okay? Why does this matter? This is interesting. This is an extreme spike in profit volume across all the cohorts. So you see every single cohort spike massively. If you look over here, the other spikes have been when we're in extreme price discovery and making all-time high after all-time high after all-time high. So you can see this just goes back to 2019, but you can see these spikes seem to correlate with parabolic bull runs. Like you can see here in 2024, you can see here in 2023. And so it is interesting that this is spiking while the price is declining, not appreciating. Now, why would this be happening? I don't know. You can come up with all sorts of different justifications. Are people believing in the 4-year cycle? Are they front running? Are they trying to manifest the 4-year cycle and seeking exit liquidity? Are people strained financially because of the tight liquidity? People are getting margin called. People are needing to post collateral in other parts of their life. It's interesting, but the point is the fact that you're seeing a spike in this data while Bitcoin's going down, to me, shows panic profit taking, mechanical de-risking. So again, when markets get extremely illiquid, people have to de-risk. You have to sell what's liquid. You sell what you can, not what you want. And capital rotation.
Bitcoin didn't crash. It cleared the room. Over 5% of the supply changed hands near $80,000 in a sharp, panic-driven reset. This wasn't a slow bleed. It was a liquidity vacuum, unexpected, fast, and brutal. No structured bids, no warning, just forced selling in dry markets. ETF outflows, unrealized profit losses, and low volatility painted the picture. But none of it signals the end. This was anxiety, not apocalypse. And history says moments like this often lead to breakout highs. Bitcoin's decline wasn't capitulation from die-hard holders. It was tourists bailing under pressure. As short-term losses spiked to FTX-era levels, weak hands rushed for the exit. The data shows panic selling, not cycle topping. What followed was textbook, long-term holders distributing into strength, not euphoria. Add in record drawdowns, squeezed liquidity, and ETF-fueled exit ramps, and it's clear Bitcoin isn't collapsing. It's flashing a signal. This is mid-cycle stress, not the beginning of the end.
So if I go next, this is even more interesting to me. So this is long-term holders spending indicator. So what are we looking at here? When long-term holders, so this is 155 plus days, so not that long-term, but nonetheless, I guess that's what we count in this visual. The point is, these little orange segments, again, they correlate with either parabolic moves traditionally, like the local highs. And so this one is interesting. Why are quote unquote long-term holders? That's the other thing about this metric, by the way, guys, is that people say OGs are dumping, OGs are dumping. But you look into the data and it's like an OG is someone who's been holding Bitcoin for 3 years. That's an OG. It's as if like the people from 2010 are selling all their Bitcoin and now you get all this FUD about quantum, all this bullshit. And none of it's true. You look into the data and that's not an OG. Like I think of an OG 2015, like pre-SegWit, pre-2017 bull run. Everyone has their own definitions. But anyway, just wanted to make that point. I digress. They're selling into, weirdly, weakness, which is a little bit interesting. Again, is it 4-year cycle speculation? Is liquidity so tight that people need to rotate capital? Or, like we talked about before, is Bitcoin going through its IPO moment where these holders finally have the liquidity to exit? Where before, selling 80,000 Bitcoin was impossible. You'd move the market too much. And so now that you have these ETF flows, the corporate flows, the public companies buying loads and loads of Bitcoin, you have exit liquidity where you get to see some distribution. But again, the point of this visual, this is not a blow off top. This is not the end of a cycle. All of this data points very firmly to a brief stretch of liquidity dislocation, of liquidity stress, of forced selling and of panic selling from short-term holders. Because look at this. This is short-term holder realized loss. I'm going to say that again. This is probably my favorite one. Short-term holder realized loss. Take a look at this, guys. Black is the Bitcoin price, the black line. Orange is the short-term holders realized loss. Look at that spike on the far right. It almost made an all-time high going back to 2022. Now, November 2022, does anyone remember what happened then? FTX. That's when FTX blew up. So fast forward to today, short-term holding realized loss. So these are not real Bitcoiners. These are tourists, people looking for a short-term trade, people looking for momentum, people swing trading, people day trading. These aren't the stay humble and stack satsers. These aren't the loyal Jack Mallard show listeners. No. Tourists, I tell you. And they capitulated. This is what we love to see. They capitulated, they got rid of their coins at a loss, at the highest rate since the FTX implosion. Again, guys, you love to see this because if I go all the way back to my first one, over 5% of Bitcoin changed hands during this dip. Unbelievable amount of distribution. And when you go to this one and you see that near FTX levels, like we were off by a pixel to FTX levels of realized loss from tourists. These are all extremely good signs. Another one, when has the Mayer multiple been this low? Okay, so all of the indicators, the fear index, RSI, Mayer multiple, it shows that Bitcoin is going to operate from an extreme level of strength. There's not that much downside to be realized left. And we're sitting at 88,000. Really, really healthy sign. And then this screenshot from Charlie, at 80,600, Bitcoin is now down 36% from its all-time high of 126,300 in early October. That's the biggest correction off an all-time high since 2022. Is this unusual volatility for Bitcoin? Not at all. We've seen similar or bigger drawdowns every year. Every year. Guys, the last time we saw something like this was this year. April 7th, Liberation Day. Okay? We've seen 33%. And again, could it get to 94% down, which we saw in 2011? Sure, technically anything is possible. This show's not financial advice, right? I'm not your dad. I'm not your babysitter. I'm not your financial advisor. But to me, this is much more structurally. Look at the area here in 2017, okay? Down 33%, down 39%, down 40%, down 30% from highs. By the way, guys, 2017, the price opened January 1st, I'll never forget it, at $1,000, and it hit $20,000 that calendar year. So 20x, and it experienced that parabolic move while being down 30% from highs, down 41% from highs, down 39% from highs, down 33% from highs. To me, what are we living through now? Look at this. Down 32% Liberation Day. Down 36% government shutdown. Repo market stress. Trade surplus. Remember, government surplus, private sector deficit. Government deficit, private sector surplus. We've been told the US isn't worried about the strain, everything's fine, Bitcoin's tanking because of quantum, Bitcoin's tanking because OG believers don't believe in it anymore. Wrong, no, incorrect. Bitcoin's collapsing, it's going to 10K, bear market, no, wrong, incorrect. There's no liquidity in the financial system, and Bitcoin's the only free market that can tell us the truth. Because all your other bullshit indicators, all your other legacy fiat financial system, it doesn't tell us the truth. It's centrally planned, it's controlled, it's at off hours, it's overly regulated, isn't audited. So what's happening? There's no liquidity in the system.
Bitcoin is shaking out the noise, and the whales are loving it. While short-term holders panic sold into weakness, wallets with 100 Bitcoin or more quietly rose by 91 in just 2 weeks. At the same time, the smallest retail wallets are disappearing. This kind of supply rotation, retail capitulating while long-term capital steps in, doesn't scream collapse. It whispers setup. These patterns rarely happen at cycle tops. They usually mark the messy, emotional middle where conviction gets tested and new trends quietly form. It's exactly what Jack Mallers warned about. This isn't euphoria unwinding, it's liquidity dislocation. A forced reset, not a structural breakdown. With short-term holders realized losses nearing levels seen during the FTX implosion and major ETFs facing outflows, the signal is clear. The weak hands have left the building. Bitcoin's Sharpe ratio might be scraping zero, but that's historically when asymmetric opportunities emerge. Volatility is low, futures flows are bottoming, and key indicators are aligning for something bigger beneath the surface. Sure, the headlines say Bitcoin's dead, again. But when the data shows retail fleeing, whales scooping, and on-chain pain peaking, it's rarely the end. It's the part where the story gets good. The market doesn't reward comfort. It rewards positioning through discomfort, and right now, that discomfort is everywhere. In other words, the market is reloading, quietly, carefully, and like in 2019, 2020, or even April 2024, these cycles of fear often give birth to something much bigger. That something doesn't shout, it accumulates. As we wrap up, what price do you think Bitcoin touches next? $75,000 or $100,000? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to subscribe.